Welcome to Winning by Not Losing. This special episode is called The Impossible Ask, because that's what it is. Beating the S&P 500 and managing downside risk every single quarter, every year. It's what every investor wants. But let's be honest, it's next to impossible. Imagine building a portfolio that doubles the S&P's return over a decade with no drawdowns. Sounds like the dream, right? But even that strategy? It still loses to the market half the time when you zoom into monthly returns. That's what we're unpacking today. Joining us is Sudhir Holla, CEO of myStockDNA. Sudhir, great to have you here. You've said this is something you hear every single month. What kind of calls are you getting?
One advisor panicking after a Trump tweet asking if we should move to cash. Another wonders why the model didn't go all in on the rally. Different moods, same impossible expectation. Beat the S&P consistently while also avoiding every downturn. Most retail investors want a roller coaster that only goes up. Right? Let us look at what that portfolio looks like and analyze it mathematically instead of emotionally.
This slide shows an ideal blue line portfolio with nearly double the return and zero drawdowns compared to the S&P 500. Doesn't it look perfect?
Yes, it does. But when you break it down month by month, you will see that even this ideal portfolio still lost to the S&P nearly 50% of the time. The slide shows the number of months that the ideal portfolio beat the S&P 500 and the number of months it lost. Winning in the long run doesn't mean winning every month. Investors don't always see that.
These slides shows the same win-loss ratio as we zoom out to quarters and years. The win-loss picture improves.
Yes, time heals the perception, but you're still not beating the S&P 500 every quarter, nor are you beating it every year. Some investors, though, live in 30-day windows. Interestingly, that expectation also increases when they pay fees to an advisor to manage their money. The expectation is that an expert financial advisor should be able to beat the S&P 500 every period.
Let's bring up the slide on Darwin's actual portfolios over 5 years.
You'll see our portfolios muted the drawdowns in 2022 and 2025. That's success. But the flip side is we didn't bounce back as hard, and that's where people feel like they're missing out.
A lot of that comes down to reacting to headlines. What's your take?
Headlines are noisy, not predictive. In January 2025, we had great jobs numbers. Markets sold off. Why? Because strong jobs meant delayed rate cuts. Earnings season, Microsoft and Coinbase beat expectations but fell anyway. Market sentiment doesn't follow logic. Brexit polling whipped markets before anything even happened. And then there's Trump tweets. The Wolfefe index exists for a reason.
So how do advisors react to their clients, reacting to news and asking for changes to their portfolio?
I think most financial advisors will acknowledge that in addition to managing money, they also need to be psychologists. Their success lies in also not letting their clients walk off the cliff and make bad financial decisions. That responsibility becomes easier if they are able to educate their clients using facts and data points. The content of this podcast and others are intended for just that. Educating them using facts helps them address the emotional overreaction.
Let's wrap with this slide, the 10-year chart.
This slide shows the results of being patient with portfolios that cater to different emotional risk frontiers. That's winning by not losing. But you only get that if you stay invested, not if you jump off every time the news rattles you or jump in every time the news is positive.
Which brings us to the real job of an advisor.
It's not to beat the S&P every month. In addition to being the money manager and the psychologist, it is also important to educate, to guide, to help clients stay on the ride when the market and the media get loud.
Sudhir, thanks again. For all our listeners, patience is the real alpha. Until next time, this is Winning by Not Losing.